Hi, today we are looking at the Affirm IPO. It will trade under the ticker AFRM stock. So it's AFRM stock. We are looking at the Affirm IPO, going to IPO within the next few weeks. In one scenario, the stock at its most recent valuation, that reported valuation, could have over 200% upside. They're growing revenue nearly 100% year over year, so super fast growth that's getting a lot of investors' attention. This video goes over pretty much everything you'll need to know. A lot of the key points like what's their business model, what's their target opportunity, what's the valuation of a valuation sheet you can play with at the end. And broadly speaking, there's a lot of exciting IPOs going on right now. I've done videos on Airbnb, C3.ai or AI stock, DoorDash, Dash stock just popped 80% plus today. Roblox stock IPO'd. Also, I did a Roblox IPO video. So I've done videos on all of these before they went public. So if you want to get the breakdown of it, there's in the contents or comments below, I'll have a link where you can click on it and you can see all the videos I've done that are sort of these let's walk through each company so you can understand it. This video goes out to Dave, who's an Unrivaled Investing Journey subscriber, and goes out to the rest of all of my Unrivaled Investing Journey subscribers. So let's actually do a quick plug, 10-second plug. You are watching Unrivaled Investing. This is a no-hype financial channel that is mission focused on finding you exceptional companies and unrivaled investments. My goal is to try to find you potential multi-baggers. So if you're interested in that, hit subscribe button. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to try to find those multi-baggers for myself, for my personal portfolio, go to unrivaledinvesting.com, click on Journey. Let's dig into the Affirm IPO. So what is Affirm? Their stated mission is to deliver honest financial products that improve lives. Their real mission, in my opinion, is to displace, this is what I'm saying it is, displace the existing credit card industry, which can use predatory and confusing tactics like deferred payment and high interest loans. That's how I think of it. It's not just about honest financials. That may be a guiding light, but it's, hey, let's disrupt the credit card industry. Let's chop up those credit cards because we think we can do it better in a way that consumers will like and disrupt a huge $100 billion plus market. So what is Affirm's value proposition? And we'll cover it from both the consumer as well as the merchant perspective. And so from the consumer's perspective, it's about a seamless checkout where Affirm is a monthly payment option. You can see here, let's say you like this $500 chair. You can see as you're going through it, that's an option. Affirm is a monthly option that you could select where it's supposed to be friendly. It's supposed to be straightforward. There's no unexpected fees, no fine print that you need to read, no late fees. In the history of Affirm, they've never had a late fee that they've charged a consumer. It's supposed to be consumer friendly. Just repeat that over and over. It's supposed to be a consumer friendly product, enabling consumers to afford things that they might not otherwise have been able to afford upfront with an upfront sort of payment. And you sort of see this business model play out over and over again throughout time. But here's the detailed example where, let's say you're trying to buy something for $1,000, where you can choose how you pay. So, in one example, it's $333 a month. You spread it out over 3 months. There's zero APR, so there's zero interest rate that's charged to you, and it's very straightforward. The max that you're going to pay, you're not paying a cent more than this, even if you're late, is $1,000. And I'll get to that late part in just a second. Then the other option is, hey, what if you want to spread it out over 6 months? Well, then now you are going to have some sort of interest, charge. And then they tell you very straightforward, look, over 6 months, it's this $44.21, and this is the total. Or you can do 12 months, where once again you get 15%. Here's the total interest. Here's the total amount you're going to pay. Total ever. So it's trying to be super consumer friendly, and the way to think about it is the longer your duration, the more interest that you're going to pay, which makes sense. But the interest is not like credit card interest, and we'll get into that in a second as well. So they're trying to revolutionize, from the consumer's perspective, how we buy things. You could see, this is sort of how they walk through the whole thing, where it's transparent. That number that you see, in the prior example, 1,044, 1,083, that number never goes up. That is it. It's not lower, it's not higher. It's flexible in that when you're setting up how you want to pay for it, you can choose the schedule that works for you as a consumer. And three, it's fair. They won't charge you late fees or penalties of any kind. So Affirm is a better way to buy things. And this is the key part, because they're trying to help you avoid unhealthy debt. And what's that mean by unhealthy debt? So the way the credit card industry works is that they charge a really high interest rate, like way above the 15% that Affirm's talking about, closer to 20, 30%. And it compounds. That's where it really gets you, because if you don't pay off that interest balance or that interest rate, then that 30%, now you're going to have to pay 30% on top of the 30%. And that's you want compounding working in your favor, not against you. Whereas here they're saying, look, that's what sends people into this death spiral. Is you get credit card debt and then it just starts compounding on itself, and you can't compete with a 30% interest rate. That's even Warren Buffett over his career at Berkshire Hathaway, it's not 30% that he's compounded at, it's 20%. So you just can't compete. You get into a death spiral once you get into that unhealthy debt. So what if you have a product where it's like, look, this is the amount that you owe. We're not going to charge you any late fees. We're not going to charge you, any sort of compounding interest. You see super clearly what it is. So what happens if you actually don't pay on time? And this is, I would think of Affirm sort of like as a club, where they're sort of saying like, look, we're going to look at like 5 data points. You answer 5 questions, and that we'll use our algorithms to look at dozens or hundreds of data points about you and make a credit decision within seconds when you're looking to make a purchase. But if you disrespect us, or you don't stick to it, and you don't meet the terms that we asked, then we're not going to offer the same terms in the future, and the game's going to change. You might not be able to get you might not get an A play with Affirm in the future if you don't respect the game. And so that's largely how it works. It's like, look, we're giving you a good deal relative to credit cards, where you don't have this unhealthy debt that's going to compound, but you need to stick to the rules of, hey, if you say 3 months, you're going to pay it back in 3 months. Now, they won't hound you down with a credit, with a phone call like, hey, have you paid it? Hey, have you paid it? They don't do that. They're very clear that they service the debt, your debt. They make sure that if you are delinquent, they'll give you text messages, they'll give you emails saying, hey, when are you expecting to pay this? But it's a completely different vibe than the credit card industry. It's trying to be a better way to buy, a friendlier approach. And so why do merchants possibly want it? And there's actually a lot of reasons why the merchants could want it. So first of all, it translates into more sales for the merchant because of higher order value and more repeat customers. So according to the Affirm website, they're saying by having Affirm as an option when you're going through that checkout, it results in an 85% increase in the average order value. So the way to think about that is it's because customers might feel more comfortable, like, hey, if I can spread this out over 6 months, yeah, and I don't have to worry about repaying my credit card this next month, yeah, I'm willing to make that $500 purchase, that $1,000 purchase, because I have faith I'm going to be able to pay it off over 6 months, over a year, and it's crystal clear. Oh, it's here's this 15% interest rate, and it's super clear what the total terms are, and that leads to this behavior where they're willing to pay for those items they might not have paid for previously, and that results in an 85% bump in the average order value that these merchants get. So that's a huge benefit on the revenue side. And they also talk about how they have a 20% repeat purchase rate. So you're building a loyal customer base if you're using Affirm, because customers are like, hey, I had a favorable experience, and so why not do that again? If, let's say, I bought a nice watch, I want to buy another nice watch, or it's glasses, and I need to get a pair of sunglasses, and I like the Affirm experience. I like spreading it out over time. So you could see why this would appeal to merchants. More sales, equals more profits, and that's more value for those merchants. And it's to present the optimal payment option for every shopper. That's the point, is you're creating flexibility for the consumer, unlocking more approval. So there's less abandoned carts. And that's a big issue that a lot of merchants face, is you get all the way up to buying it, and then you're like, you step away from it. You're more likely to pull the trigger when you can say, you know what, it's only going to be 1/6 of the payment this next month as opposed to the full amount that I'm going to have to owe next month. So this is, it's super interesting. They're talking about how they ask just a few questions, but results in, they evaluate over 150 data signals per consumer to sort of spit out like, hey, here's the personalized payment options for this consumer. Another key element why the merchants like it is that it enables them to build up their brand and avoid doing gimmicky promotions or discounts that hurt their brand. And that's it. That's a key element, is you don't want to get into the race to the bottom. Like here you can see Solstice watch, pay over time. It's a $600 watch, and they're saying, look, do you want to spread it out over 3 months using Affirm? You know, you don't want to get the race to the bottom where you end up on Wish and you see products that are knockoffs for 13 bucks a month. You don't want to get into that race where you're getting your brand crushed, where the brand association is just completely getting, demolished over time. You don't want to go down that race of discounting from a brand perspective. But that's not all. Where Walmart uses Affirm, they use it both online and in store. And from Walmart's perspective, here it's really beautiful, where they're like, look, we're going to let the suppliers duke it out. Now, what do I mean by that? They effectively tell their suppliers, like, look, you work with Affirm if you want to offer some sort of deal. Effectively, Affirm gets a cut, a merchant cut. Therefore, this will be a deal that's backed by Affirm, and where you can get these different payment options when you're buying from Walmart. And you're effectively getting the suppliers to compete with one another, so that the suppliers, not the merchant, not Walmart, but Walmart's suppliers are the one trying to figure out, hey, do we need to cut some sort of deal with Affirm, pay Affirm, so that way Affirm's willing to offer this, as a payment program. So Walmart, in this case, the merchant doesn't have to mark down their inventory. They don't have to do further discounts. They can keep their margins, but the suppliers need to figure it out. And if they do it, they see higher volume. So generally they make up for it with getting more sales. So that's, Affirm is not just impacting it on a brand level, but also the big box merchants that have multiple brands, underneath them. Then there's also the Affirm, the app, which, honestly, it really surprised me. I sort of thought, like, this seems sort of like the tail wagging the dog. But the reality is, a lot of people have reviewed it. It's rated 4.9 stars. Nearly 500,000 people reviewed it. And the point being is that it's allowing, this is sort of their approach to how do we start expanding our solutions for all consumers, because it's not only the deals that are currently available through Affirm and the select merchants. Now they're saying, look, any merchants that aren't even yet integrated with Affirm, they create a virtual card when you do the Affirm app, where Affirm earns part of the interchange fees performed over the Visa rails or the Visa network. But it's even if a merchant hasn't set up that relationship yet with Affirm can still say, oh, you want to make this purchase? We'll treat it like a virtual credit card, and let's do that special, like, hey, you can select 6 months, 3 months. So that's super interesting. And then they're moving, this is part of their example of trying to move into, a friendly, financial system, or consumer friendly, is they're now offering a high yield savings account. I'm not sure how high that yield can be in this environment. I suspect it's well under 1%. But this is, you could see that they're moving in beyond just going to the merchant. Now it's the app as well. And a lot of people do like the app because it's all in one place. You can see which merchants have deals with Affirm. So now it becomes sort of a point where you're like, oh, I want to go shopping. I can use the Affirm app to look for where I can easily afford things. And so you start going through there. So what is Affirm's business model? I sort of talked about, I talked about what they do, but I haven't talked about how they're making money, like where's the revenue coming in. And so you can see here, like, this is a little bit convoluted, so this is straight from the company, so hold on, bear with me as we go through it. So you have a merchant here, and you have a consumer, and the consumer wants to buy something for $1,000, and the consumer purchases from the merchant this item for $1,000. The consumer has been approved through Affirm, And Affirm works with a bank, primarily Cross River Bank. Cross River Bank sends $950 to the merchant. Now that $950 is $50 less than the $1,000 price that the consumer just paid. So the bank sends $950, they hold back $50, and that $50 is effectively revenue for Affirm. That's part of a deal that the merchant has agreed to with Affirm, saying, hey, any transactions that go through our platform, you get to have 5% of it. Now that's a nice take. Now why would they do that? They do that because the merchant's getting this huge uplift in the average order value that more than makes up for this 5% or this $50 fee in this example. So then what happens is the consumer effectively has a $1,000 loan that they have to repay in time. Now, are they repaying the bank or are they repaying Affirm? Affirm, within a few days, will buy that $1,000 loan that the bank provided to the merchant. Affirm buys that loan for $1,000 plus a fee to the originating bank, and then the consumer will be paying back Affirm over time. They'll either be paying it in the 0 APR or no interest rate, or they'll be paying it with that interest rate. So the way to think about it is there's a few different sources of fees here. This $50 merchant fee, that's a big one. That's 5% of the transaction about, and that's a big percentage of their revenue. We'll get into that in a second. Another aspect is the interest payments that the consumer is paying based on their product. If they bought it and let's say it's a 15% APR, that's going over here. Next, there's some small charges for like servicing the loan. Now, the business model is dependent on this relationship with the issuing bank. And so this does create somewhat of a potential choke point as their loans are predominantly issued through one bank, which is Cross River Bank in New Jersey. So here you can see the detail of their revenue, where the merchant network revenue, that's the cut of the transaction. And you can see, look, this is growing super fast from, in the most recent quarter from 88 million to 174 million, nearly 100% growth. What's driving that? You can see this merchant network revenue is growing super fast. That's a huge component of it, and that's going to result in higher margins over time. And that's 53% of their revenue. So that's going to be higher margin product or higher margin revenue for them. And so you can see that also implies about a 4.6 about a 5% charge, because this 256 million in revenue in the fiscal year 2020 off of 4.6 billion in volume that goes through their platform implies about a 5% plus charge. The other component is this, which is about 31% is interest income, so that the consumers that take out loans, and let's say it's 15% loans, there it is. It's about 15% of their. It's about 31%, of their revenue, and then the remainder, it's the gain or the gain or loss on the sale of their loans, servicing income, and what I mentioned earlier, the virtual card revenue as well, and all in, that's about 15% of the revenue. So the key contributors are this merchant fees and the interest income. Those two components alone are 80 to 90% of their revenue drivers. So then, but just seeing those revenue drivers doesn't show you what the real margin story is. And you see that you have to walk through, let's say here it is, 510 million in revenue for the fiscal year 2020. And you need to start factoring in several things like, hey, what's the discount you take on the loan? What sort of credit loss do you expect, for this loan? What is the cost of borrowing to buy that loan? What are the servicing expenses, the processing charges associated with it? So all in, when you're looking at this revenue profile, currently it results in about a 35% margin on the revenue. Now this margin profile will increase, I would expect, if they could increase the amount of business tied to merchant fees. And so seeing this fast growth in merchant fees is a net positive development for the company, as it results in higher margin business, because the interest income is really a spread business that's offset by the funding costs and the provision for credit losses. So what's driving the business? You have 6,500 merchants that currently use them. 100% dollar-based merchant retention rate. So in other words, the merchants that are doing business with them, the dollar amount is increasing year to year. Even if they didn't acquire any new merchants, the amount of business through them would be at least 100% the next year. Consumers seem to love it. This is an unheard of score for a credit product. I mean, 78 on a net promoter score means nearly 80% of the users would recommend this to others. And that's really critical when it comes down to, spreading your sales and marketing. This is just such an important variable. And over the lifetime of their platform, Affirm's platform, they've had 6.2 million consumers use their products. And you could see, look, the amount of money, the amount of transactions, the gross market value or merchandise volume that's going through their platform each year has just been growing exponentially from a couple $100 million to $4.6 billion in fiscal 2020. Now that was fiscal 2020 that ended in June 2020, and that's 77% growth from fiscal 19 to fiscal 2020. Now the question is, what makes all of this possible? I mean, 77% growth is almost unheard of with financial products. And what makes all this possible? Oops, let me hide again. What makes all of this possible is that they effectively have a better algorithm than if you just use the FICO scores. And that's what you often see, used by various different lending products. And so for a given level of risk, our proprietary risk model is capable of accepting significantly more applications when compared to FICO scoring methods through a superior ability to price risk. So that's a key item. That means they have a competitive advantage relative to those that are using FICO scores to price risk. Alternatively, for any given consumer subsegment, our model produces lower risk outcomes when compared to FICO. So look, if you look at this is a key part. So this is percent of first month's delinquencies, where they're showing, look, based on our model, we think, this first decile, second decile, we're pricing in, let's say 2, 3, 4, 5% delinquency, whereas using FICO would be pricing in, let's say maybe that's 10 or 15%. That's a huge, the difference between these two lines is the amount of business that a firm can generate that other traditional lenders wouldn't be able to provide. And they're able to do it at a better interest rate than others. And so this is really the secret sauce that is powering a firm's growth. Their ability to underwrite risk better than the traditional models. And you can see here it is their portfolio net charge-offs. So for the loans, that they end up, holding on to, the 6-month loans, let's say on average, you see the charge-offs for their different cohorts. Here's the January 2018, within, from this January 2018, within 6 months, you can see the charge-offs went up to 4%, 4.5% of the portfolio and sort of steadied out over there. And then if you see January 2019, dramatically better. Now it's 3%. Here's January 2020, which is really incredible. Here it is in the middle of the pandemic. Their January 2020 cohort is performing better than January 2019. Now this is through September of 2020. So that's really incredible, and it reflects that as time goes on, it becomes increasingly difficult to beat their model because they have more data, which is creating better underwriting inputs. So they could say, hey, we know what the algorithms really show, and we're able to fine tune it such that our net charge-offs are really low, between 1% and 2% of the portfolio. And this means they're able to do better underwriting at the end of the day than their competitors. So what are the thoughts about the marketplace? And now I'll do the correct switch. So the thoughts about the marketplace is, look, they're clearly tapping into a huge market. And here they talk about in 2019, consumers paid approximately $121 billion in credit card interest, $11 billion in overdraft fees. Those two pieces largely are gone. Now, the credit card interest is still there. It's going to be a lot less because you don't have that compounding aspect, and it's a lower rate. And they're primarily offering zero APR. That's like half their book is 0% APR sort of deals. And there's also $3 billion in late fees. That $3 billion in late fees gone. If everything adapted to the Affirm business model, this would dramatically save consumers a lot of money. So they're tapping into a huge market, looking to disrupt a huge $100 billion plus market. And the market's growing real fast, which you can see here according to WorldPay's 2020 Global Payments Report. Buy now, pay later is the fastest growing e-commerce payment method globally. Fastest growing. In North America, buy now, pay later market share is expected to triple to 3%. That's barely anything. That's barely any percentage of the revenue of the e-commerce payments market by 2023. In other regions, such as EMEA, buy now, pay later already accounts for almost 6% of the e-commerce payment market and is expected to grow to almost 10% by 2023. You're talking about minor percentages of the market growing super fast, disrupting a huge market. So when I'm thinking about a company that has a couple million in revenue, does this have 10x potential? I'm checking that box and saying, yes, it definitely does. And that's part of the reason when I lay out the investment scenarios on the high side, you can, assume on the high side that there's a good growth rate there, potentially resulting in a great potential return after it IPOs. But, and this is a key part here that you're going to need to think about, is that they are not unrivaled. And keep in mind that unrivaled lens is what I use for all prospective investments that I look at, because if you're not unrivaled, that means it's going to be harder to grow. You still might be able to post some incredible growth, but ultimately it gets harder and harder if you have a bunch of competitors. And you have Klarna, you have Afterpay. Here's Afterpay. Afterpay's public. And they are competitors that are multiples of a firm size, and they're growing as fast or faster than a firm. That makes me nervous. That makes me, for sure, you're not unrivaled. You are facing really smart competitors that are growing very quickly. And they're profitable too. They don't have 6,500 merchants at Afterpay. They have 55,000 merchants, multiples of their size. They don't have 4.6 billion in volume going through their platform. They had 11 billion going through their platform. So I look at this and I'd say, oof, that is definitely a blow to my excitement about getting in on the Affirm IPO. So what's the next component? Even more competition. Here it is. You see PayPal, make it a holiday season to remember and get the gifts they want now, but pay for them later. Just choose Pay in 4 at checkout at millions of online stores and split your payments in 4, one every 2 weeks. It's interest free and is backed by PayPal. See, this becomes a concern of mine when I see this, and I'm thinking, you know what? This becomes a risk that you have more and more players somehow enter this game with some sort of data and make it tricky. Like, could Stripe somehow get into this space? Could Adyen, it gets tricky. It's not clear to me, but seeing 3 players that are already there in this space that are not Affirm and they're real players to respect, in my opinion, it does make me a little on edge. Now, maybe they're tapping into such a big market that, if they get 5% of it, it's still a 10x, it's still a huge multi-bagger. Then, multi-bagger stock can go up hundreds or thousands of percent. So that's sort of the question you start facing is even if they're rivaled, are they tapping into a market that's big enough that they could still grow significantly? That's the question you would need to ask, if you're like, hey, I really want to own this stock. What are my thoughts on valuation as I look at this? And so here it is. This is an article that talks about how Goldman Sachs is looking to bring them public. And if I ghost myself, you'll see they're talking about up to a $10 billion valuation over here. Bring myself back. So what's the valuation? If you assume that $10 billion valuation, what's the prospective returns that you could face if you were to buy at that valuation, if it IPO'd at that valuation? That's a big if. Right now, it is a bubblicious time where things just pop 80% the first day they start trading. Man, that's the environment we're in. Everyone seems to know that everyone's playing the same game apparently. Hey, Federal Reserve's keeping interest rates low. Why not pump this sucker up? But let's stick to the Affirm stock. So here it is. You can see the $10 billion valuation here. They did around $500 million in revenue for their fiscal 2020. And keep in mind, this is my value proposition to you as I bring this sheet available for you to play around with. You just had to download it. It's a Google Sheet. You can play around with your assumptions to think about what this looks like over time. And so, this year, penciling out somewhere around 100% growth. That's the most recent growth in their most recent quarter. So I'm saying 95 to 110% growth for fiscal 21. What's their optimized margins? This is really tough because keep in mind they're really unprofitable right now. Their effective gross margin or contribution margin was around 35%. Now, if they were to get a lot more merchant fees, I would feel more confident that they could hit a higher margin. But if they stay at their current margin profile, it'll be nearly impossible for them to have a 20% optimized margin, because that would mean they only have 15% expenses in terms of research and development, general and admin costs, and that just seems too low. Those expenses are real. They're currently losing lots of money on those. So I would say this is sort of an aggressive assumption, assuming they get a higher mix of network, merchant network fees over time. Because right now that interest income is a lower margin revenue because it's offset by the effectively their capital costs. What's it cost for them to buy that loan, from Cross River Bank, and then service that loan and the associated interest expense with that. And so I'm penciling out here 10 to 20% operating margin. Slap on some sort of tax rate at 25%. Now this is what their margins could look like over time. And you can see this is penciling out like 62 to 130 times earnings, which, that 62 relative to 100% growth would be potentially great if that optimized margin is, possible or even likely in the future. So then what's the growth rate over time? I might be a little too conservative here on the low side, just because, look, they're growing super fast now. They're tapping into a 100 billion plus market. So is there this potential, is it really likely that it decelerates from 100% to 25% annualized over the next 5 years? I like to look at things over a 5-year basis. Is it really likely to decelerate that much? Or is it more likely to be closer to 50%? 50%. And then what sort of N multiple do you assume? And, I sort of slapped on, I think a reasonable range of 20 to 30 times, because the reality is I wouldn't expect them to be at these margins even within let's say the next 3 to 4 years. So this is sort of some assumption. You would want to see them start working towards those margins to sort of get these multiples for 5 years out. But you can see in this high scenario, and I don't think anything here is that crazy. Like when you're thinking about the valuation, look, they're currently growing at 100% plus, or they're currently growing around 100%. There might be some things in the work that can get them to grow even faster, and I'll talk about that in my exclusive video. But so you may be penciling out 50% annualized over the next 5 years. Maybe that's reasonable. And this 20% margin, you are seeing an uptick in the acceleration of their merchant fees. So maybe this is possible over time. Maybe their contribution margin goes up too. And if they're posting this level of growth, maybe an assumed multiple of 30 times a few years out is applicable, in which case you are getting like 265% upside on that $10 billion valuation. That said, if you take a more conservative look, it obviously, the return isn't as attractive. It's closer to single digits, return on investment over time. This is 28.5% over 5 years. So it's not as compelling, or 50% decline over 5 years. And that would assume a dramatic deceleration and a low multiple. I mean, if this scenario were to hit, there's a good chance I'd say that it goes even lower than that, just because you'd probably get a lower multiple if their growth rate were to decelerate that significantly. I'd say in that scenario, investors are like, oh, you're clearly rivaled. This is a tough, you're getting out at that. So, and obviously, look, the stock price, when it goes public, can obviously go way higher and way lower. And that's animal spirits. I like to have some sort of logical framework for every, prospective investment that I look at. Overall, I'm impressed with the firm's growth. I'm impressed with their value proposition. They're clearly tapping into a huge market, clearly 10x potential. It is a little concerning to see that Afterpay is multiples of their size and growing at a similar or faster clip. That is concerning. That is a red flag, just from a competitive dynamic perspective. If you want to see whether or not I'm going to buy the Affirm IPO when it comes public in the weeks ahead, it might be the first quarter 2021. If you want to see if I'm going to buy the Affirm IPO at this $10 billion valuation, I think you know the answer, where you're going to have to go to Unrivaled Investing. journey.com. Click on Journey for exclusive content. And honestly, I'm just sort of scratching the surface with the Affirm story. There's a lot more. There's a lot more that I didn't even get into on this video, but this video is already going over, like 30 minutes. Like elements like their Peloton relationship, Shopify, macro risks, thinking about the portfolio allocation, if I would, assign a percentage to it. And I'll include all those comments in my exclusive video, which I'm going to post right after this. It'll be in the comments section of this video. You can click on the link for that exclusive just for Unrivaled Investing Journey subscribers content. Now, there's other aspects, like my value proposition with Unrivaled Investing Journey is beyond just this exclusive content. So each month I try to identify one potential multi-bagger for you on your journey. The other aspect is I'm trying to build out an educational series where each month, another episode on how to think about investing, whether or not it's finding potential multi-baggers or thoughts on optimal betting strategy. That was one of my most recent videos, which is the $1 billion secret behind optimal betting. You have exclusive content like this. And then lastly, you can see what I'm doing in my personal portfolio with at least a very minimum monthly update of what I buy, sell, and hold. You can see all my holdings. And then I also generally have intermittent updates of like, hey, I just bought this, or I recently bought this, and here's why. So that's the value proposition of Unrivaled Investing Journey, and just finding one potential multi-bagger can change your journey. So if you're interested in following my journey to try to find these multi-baggers, go to unrivaledinvestingjourney.com. If you enjoyed this video going over Affirm, please hit subscribe. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.